Good to see you, Steve. Today we've got Stephen Lambeth on The View. John's away. We're recording this on Thursday afternoon. Steve, you specialise in the Australian share market rather than, the global macro stuff like John does. The market looks very expensive at the moment. We've just come off a strong rebound from the April 7 lows. The market's up about 17% since then. To me, the market looks expensive at this stage. Are you finding that you can still find attractive investment opportunities?
G'day, Paul. Good to see you as always. It's a great question. It's a difficult question to answer because for the job of managing people's hard-earned and investing with a focus on fundamentals, we always have earnings in the foreground. And the earnings story isn't really connected into the price story. So that's why you've just made reference to a very elevated multiple. It is all about price action. It seems to be sentiment and liquidity, less so earnings delivery. The Australian market, as you know, for some time has been struggling on the earnings front, and it's in part representative of the composition of our stock market. And I do find it quite curious to get into the mid-19s as a multiple and no earnings growth, sits alongside the US in the low 20s, but with an amount of earnings growth. So hard to find value. And a message that I've been sharing with John on the road presenting to clients is the importance of being different. And that's just become a more acute issue given where we find ourselves.
Yeah, so part of the reason why markets have bounced so strongly since that 7th of April low is that there was a fear that the US might be entering a recession, and even Australia might be experiencing a severe slowdown. But since then, those fears have dissipated. Trump has walked back a lot of the tariff talk, and although there will still be tariffs, they'll be at lower levels than feared. And also we've seen China, its growth expectations are somewhat better than they were some months ago. So when you look at the market and you're trying to find opportunities, I guess it doesn't matter where the market as a whole is, it's just the individual stocks that count.
Yeah, that's exactly right. It is, as I've said before to listeners, we're very humbled by the complexity of the macro environment. It is very hard to know how to navigate, whether it's trade matters, whether it's commodities, whether it's inflation and its influence on policy settings. Many hardworking strategists and economists have time and again shown a 50-50 kind of outcome on the success rate of getting things right. So on that observation and how complex the environment is, at all times our job is to be looking for companies and focusing on their individual attributes.
Yep.
Of course, the macro matters. You have to overlay the external environment. You have to think about, say, a topic right now, Paul, would be the status of the A dollar and the US dollar.
Yep.
So that amount of investment in offshore companies with US earnings needs to be thought about. But the message simply is, as always, when we put our best foot forward for our clients and invest, it is by and large a portfolio that comes from individual companies with their individual attributes and the specific value creation characteristics that they have.
Well, let's talk about two themes that are driving markets at the moment. So the one you mentioned, the US dollar has been very strong. Expectations now are that as the Federal Reserve, cuts interest rates, the US dollar will weaken. Our dollar's knocking on the door of 65 US cents. We expect that to strengthen in time. So how do you take those factors and the fact that central banks all over the world are cutting rates, how do you take those two themes, if you like, and choose individual stocks? And can you give us some individual stock examples?
Yeah, sure. Yeah, of course. So let's do FX first.
Yeah.
Absolutely. The depressed status of our A dollar, it is, I I guess the comment up front is it's hard to actually relate to why Australia is down and out from a dollar perspective. People spend time on interest rate differentials, growth differentials, maybe commodity prices. I would also want to throw in indebtedness and debasement and monetisation of debt as reason why our dollar should be stronger. So to the extent since Liberation Day there's been a brighter light shone upon the fiscal deficit situation, the debt debt issue of the US, it is a more acute risk that we are thinking about for our portfolios. The good news is, however, I would note, for the stocks that we have, if I just make reference to our concentrated equity portfolio, this is our flagship fund that we put in front of clients as our best foot forward, offering both growth and income attributes. We only have 6 stocks out of the 23 that have US exposure, and where each of those stocks has exposure, it's not 100% exposure. It's limited to the percentage of their business that either operates or derives revenue from the US. And when I weight that through, it adds up to about low double-digit percentage exposure. So it exists, but it's not sheep stations. And I should also add, you would have noticed, say, the euro and the pound versus the Aussie dollar. Well, that's gone the other way. Yeah. And there are stocks that we own that have businesses in those markets that are, as it turns out, will be beneficiaries. So it's a very balanced picture on that front. The more pressing issue for an investor is if they're in international equities, if they've bought the S&P 500, they need to think carefully about how to manage FX exposure because it's 100% US.
Yeah.
On central banks, the quick comment is, as you can appreciate, like the dollar and FX, these external factors have influence in how we think about risk, less so how we think about how to pick stocks. With rates coming down, absolutely, that will breathe some life into various businesses in various ways. But of course, we only let that have limited influence on what it means to nut out an investment thesis and say, here's capital we should put to work. And the reason I say that is twofold. One is markets are already looking forward and thinking about rate expectations. And of course, just because rates have influence on certain types of companies, if we took REITs as an example, doesn't necessarily mean that as the theme plays out, it necessarily drives a uniform impact across each of those companies. So obviously REITs, infrastructure utilities are front of mind. Banks go the other way. As rates come down, that presents a headwind. And the last one is probably mentioning consumer, where the household sector here has suffered from high mortgage rates. That will breathe life into that sector, but you have to choose carefully. An example would be JB Hi-Fi. They have defied any amount of visible pressure on the consumer from high mortgage rates. So you can't really presuppose as the rates come down, it somehow further turbocharges their exceptional performance.
Steve, you've given us some insights into the various sectors. You mentioned JB Hi-Fi. If I were to put you on the spot and ask you to highlight a couple of stocks that you think are really attractive at the moment that we've been buying or are set in, and perhaps a couple of stocks that you think ought to be avoided for whatever reason.
Yeah, absolutely. And the framework we use, as you know, Paul, is we're trying to do two things well for the portfolio and our end investors. We're firstly focused on what are the wealth creation prospects of a company. That's the science, if you like. And then the second question becomes what's reflected in the share price. That's the art. That's where we have to bring judgment. Yeah. And so our portfolio position at the moment, I might as well mention a stock we own that would make clear this is something that we like. We have deliberately positioned our portfolios away from the index in the context of banks are big in the market. CBA's reached 29 times. It's certainly in some sort of bubble territory. Yeah. So we have a position, it's about 5.5%. The index is more like 12. And so that sort of 7% difference is capital we've put to work in a name like Ramsay. So Ramsay is a turnaround story. They've blown up shareholder funds with a prior chapter of trying to prosper overseas. They're now
In the
addressing those
hospital
problems.
business, they own hospitals in France. Yeah.
That's right. So that they are on a journey of betterment under new management, board refresh, and an ability to address past problems, to right wrongs, and also you would have noted there's issues going on with the number two player. The strong get stronger, and so with an aging and disease, with aging and disease as your backdrop, you can be rest assured demand for their facilities will continue to grind higher, and you have the opportunity for betterment as they also fix their capital allocation strategy. So that's one that we like.
That's Ramsay. Yeah.
One that we dislike, well, I just did some presentations with John on the road, and I'll just quickly make reference to when we're analysing companies, we do not just try to play the winning game of finding opportunities that prosper, we also try to avoid losing. That's part of investment success as well. And we have a list of attributes that we're wary of. I'll just give you one today. The attribute of synergies. So there are two stocks at the moment that are trying to promote value creation from synergies. One is Amcor. As you know, Amcor have got together with Berry. Central to the thesis, because there's very little growth from a revenue perspective to be had, central to their thesis to create value is to capture synergies in costs and bank those to shareholders. History is important. When the same such get-together happened with their prior deal, which was Bemis, Amcor was promoting an amount of earnings from synergies that have just never shown up. If you fast forward from when they first bought the business to today, free cash flow hasn't grown, nor have earnings. I think we're seeing history repeating with a company that's trying to describe an opportunity that's actually beyond reality. It will all get competed away. And similarly, we've done some work on James Hardie. They, as you know, were in the press, stubbed their toe seemingly on an acquisition that the market doesn't like for understandable reasons, not regarding necessarily the great growth prospects this company has, but more the price that's been paid, the type of environment we're in, and also here's the synergies. So synergies are in the foreground, and different to the Amcor story where it's cost, this is the unusual situation of promoting revenue synergies. Now, for my 20 years following companies, there are very few examples where I've actually seen two businesses get together and extract meaningful value from a revenue synergy perspective. So that's one that we've watched, one that we're going to stay on the sidelines of and just observe and see if there's some sort of change where actual revenue synergies land. My sense is that will not happen.
Okay, so Steve, you liked Ramsay. You gave us two stocks to avoid in Amcor and James Hardie. What's the last one that you do like that you think is still attractive, that's in our portfolios, that we're confident about the future?
Yeah, sure. Two to call out quickly. When that Liberation Day moment happened, risk came off, everything got hit. We did lean in. We had cash at the time that was surplus to our needs. So we leaned in, we added to our position in Goodman Group. We still like all the attributes of Goodman Group from an assets, strategy, management, balance sheet, and valuation perspective. And as you know, they have...
Tell the audience this is industrial property. They've got warehouses. They've got a lot of IT leased space and so on. Yeah, and it's a huge company today. Massive market capitalization.
That's right, yeah. So that's one that we continue to like. It did sell off. They did a cap raise. It's all for the data center story, which is very capital intensive, but they're very well positioned to prosper from that. So we like that one. And a last call out, you mentioned China before. We talked a bit about the status of the dollar. I mean, who could overlook the ongoing structural appeal of gold?
Yeah.
Gold looks beyond a cycle. It looks like it has the characteristics of being fundamentally more attractive, given a recognition that the debt problem in the US is simply not going to be resolved. It is a blessing in Australia. On the ASX, we have Newmont. They're a tier one gold miner. They're highly diversified. and they are attached to the tailwinds of a rising gold price. So that's another one we like as well.
We'll end it there. I did note, I saw a very interesting chart this morning which showed that central banks have as their number one holding US dollars, and gold has just overtaken the euro as their second biggest holding, the average of all the central banks. So they prefer to hold gold to the euro. Anyway, we'll have to end it there. Steve, that was great stuff, and it's been too long. We'll have to have you on more regularly. I think it's always interesting to talk about individual stocks. So to the audience out there, have a great weekend, and we'll see you next week.
Thank you.
Thanks for watching.